The Great Depression. The stock market wasn't just hot, it was on fire. People were buying stocks with borrowed money. Margin buying, they called it. You could put down 10% and borrow the rest from your broker. So if you had $100, you could control $1,000 worth of stock. When prices went up, you looked like a genius. When they went down, you were destroyed. October 24, 1929, Black Thursday. Panic selling started. Everyone tried to exit at once. The problem? There weren't enough buyers. Stock prices collapsed. Banks that had loaned money for stocks couldn't get it back. Within days, $30 billion in market value vanished, equivalent to $400 billion today. Banks failed, savings disappeared, unemployment hit 25%. The crash didn't just end, it echoed for a decade. The oil crisis crash. Fast forward 40 years. The economy looked stable, then OPEC turned off the tap. Arab nations stopped selling oil to countries supporting Israel in the Yom Kippur War. Oil prices quadrupled overnight. Everything that moved, heated, or manufactured needed oil. When oil got expensive, everything got expensive. Inflation spiked to 12%. Interest rates climbed to fight it. High interest rates kill stock prices, because why risk stocks when bonds pay more? The S&P 500 dropped 48% over 2 years. Companies couldn't afford to operate. Consumers couldn't afford to buy. It wasn't just a market crash, it was a full economic seizure. The term stagflation was born. Stagnant growth plus inflation. A nightmare combo economists thought was impossible. 1987, Black Monday. October 19th, 1987. The single worst day in stock market history by percentage. The Dow Jones dropped 22.6% in one day. Not over months, one single day. What caused it? A perfect storm of bad luck and bad technology. The market had been overheated. Valuations were stretched. Then computerized trading kicked in. Program trading, they called it. Computers automatically selling when prices hit certain levels. One sell triggered another, then another. A cascade of automated panic with no human to hit the brakes. By the closing bell, $500 billion in value had evaporated. The twist? The economy was actually fine. No recession followed. The market recovered within 2 years. It was pure market mechanics gone haywire. The Asian financial crisis. Thailand's currency collapsed. The baht lost half its value in weeks. Why? Thailand had borrowed heavily in dollars, but earned in baht. When the baht weakened, their debts doubled overnight. The crisis spread like a virus. Indonesia, South Korea, Malaysia all fell like dominoes. These were the Asian tiger economies everyone had praised for years. Now they were begging the IMF for bailouts. Global investors panicked. If Asia could collapse, who's next? Russia defaulted on its debt in 1998. Hedge funds imploded. Long-term capital management, a fund run by Nobel Prize winners, nearly took down Wall Street. The Fed had to orchestrate a $3.6 billion rescue. The lesson? Global markets are connected. A fire in one room can burn down the whole house. The dot-com bubble. The internet was going to change everything. And it did. But not the way investors thought. Companies with zero revenue and no path to profit were worth billions. Pets.com spent millions on a Super Bowl ad. They sold dog food online. Their stock soared, then they went bankrupt 9 months after their IPO. The Nasdaq hit 5,048 in March 2000. Then reality set in. Earnings matter. Profits matter. Business models matter. The Nasdaq lost 78% of its value over the next 2 years. Trillions in wealth deleted. The crazy part was, some companies survived and thrived. Amazon, Google, eBay. But for every Amazon, there were 50 Pets.coms. Investors learned an expensive lesson. Hype doesn't equal value. The Great Recession. This wasn't just a crash, this was a near-death experience for capitalism itself. It started with houses. Banks were giving mortgages to anyone with a pulse. No job, no income, no problem. They called them ninja loans. No income, no job, or assets. Why would banks do something so reckless? Because they weren't keeping the loans. They bundled thousands of mortgages together, sliced them up, and sold them as securities. AAA rated, safe as government bonds according to the rating agencies. Except they weren't safe at all. When people couldn't pay their mortgages, the whole tower collapsed. Bear Stearns failed. Lehman Brothers, 158 years old, went bankrupt in a weekend. AIG needed $182 billion to survive. The credit markets froze. Banks wouldn't lend to each other. No lending means no business expansion, no car loans, no student loans. The economy stopped breathing. The S&P 500 dropped 57% from peak to trough. Housing prices fell 30% nationally. $16 trillion in household wealth vanished. Unemployment spiked to 10%. The government had to step in with bailouts, stimulus, and near-zero interest rates. It took years to recover, and some argue we never fully did. Look at all these crashes together. They share DNA. Excessive optimism, borrowed money amplifying bets, a trigger event, sometimes obvious, sometimes random. Then panic, mass selling, liquidity drying up. Every crash feels unique while it's happening, but the psychology is always the same. Greed on the way up, fear on the way down. The market isn't just numbers on a screen. It's millions of people making emotional decisions with real money. And when emotion takes over, logic doesn't stand a chance. The crashes from 1929 to 2008 weren't just history lessons. They're warnings. The market will crash again. Not if, when.